what we've done that's a little bit different with this workshop is we brought together three different communities who often don't talk to each other. The donors on the one hand, the government officials on the other hand, and they often get together and they talk in the climate meetings that are going on around the world, including negotiations which are political and including other workshops which are, say, maybe less political, but basically donors and governments. What we've done with this meeting is we brought in the private sector, banking and investment community. And one way of looking at this is there are two conversations going on around climate change and financing, say, clean energy and climate-related, climate-friendly activities. One conversation is a policy community, and we call it a policy conversation about climate change and responses. The other conversation is a financial conversation, and it's mainly between investors and banks and project developers, which is focused on how you get the money out, how you invest in projects. The problem is these two conversations do not meet very often. The donors and also government officials talk a lot about leveraging private sector finance, but they don't really understand what it takes, what drives finance, and in many cases, just bringing the two parties together, say banks and fund managers together with donors and government officials, can lead to better policies to support climate finance. The cost of not doing anything on climate change are in the range of 5, 6, 7, 8% of GDP if you look at models of what the impacts would be in the year 2050. Now, the reason that there is not more attention being paid to this danger and there is not more investment being put in climate-friendly activities is because, those damages are going to occur in the future. And when you talk about 5 or 6 or 7% of GDP, that's twice or 3 times the growth rate. So if you have that impact, you're going to have negative growth. But the problem is, that is not happening now. That's a future damage. And so there have been discussions about, at this meeting, there have been discussions about a lot of case studies of ways of developing public-private partnerships, ways of mitigating the risk of investments, ways of, for example, providing insurance or providing guarantee mechanisms, and then also a lot of drilling down at the country level to get discussions between investors and donors and the country officials. And I should say something about that, which is the government officials attending this workshop. Most of them are not the same government officials who go to the climate change negotiations and the climate change meetings normally. They're the planning and finance ministries. They're the ones who are responsible for the development budgets. They're the ones who receive the donor funds and finance infrastructure, education, health. Okay? So, since climate change finance is becoming an increasingly important part of their budgets, bringing them here for this discussion is particularly appropriate. There's more than enough funding available. The gap is between the needs of developing countries, say, to fund adaptation projects, to fund scaled up renewable energy, to fund sustainable transportation, climate resilient development, between their needs and their ability to access that financing. So in other words, making bankable or investment-worthy projects. That's the gap. The gap is not the gap where there's, they need this amount of money and there's only this amount available. There's more than enough available, but the money that's out there that could be going to these projects cannot find these projects because these projects are not either A, not properly developed or identified, or B, they're just not really thought through in an investment in the way that needs to be presented for investment by a fund manager or a banker. First of all, the Fast Out of the Gate report was commissioned by USAID to, in a sense, demystify climate financing mechanisms in Asia. there are the 11 countries that are covered by the LEAD program, and there's a number of other developing Asian economies as well that really desperately need financing to fund mitigation and adaptation projects. The availability of donor financing is complex. It's available, but it's very hard to understand where it is or how to access it and what the conditions are. So the report was commissioned to basically survey and categorize the financing mechanisms that are available, how they operate, what the access requirements are, what the requirements are for measurement and reporting of greenhouse gas emissions reductions. The report focuses primarily on greenhouse gas mitigation as opposed to adaptation. So we surveyed about 200 different funds, then we interviewed 27 different donors and banks and investors across 9 countries as part of figuring out where all these funds are and how they are set up and how they operate. So the result is a report that basically lays out where the public sector funds are, also, and this is something that makes this report somewhat unique, where the private financing is. So to figure out the private financing flows, which is very difficult, we commissioned a study by Bloomberg, New Energy Finance, which basically is the sort of the main keeper of data on international clean energy projects. So we commissioned them to basically generate a report on how much investment is flowing into these 11 countries from the private sector. And those flows are significantly higher than the public flows. Broadly speaking, in the LEAD countries, there's about $1.6 billion a year. There's about $1.6 billion that's been made available over the last 3 years of climate financing. That's public sector climate financing. So that's $1.6 billion. Over the same time period, based on the Bloomberg data, there's about $8 billion US dollars. So the amount of private sector financing that's actually available and going into climate-friendly investments is about 5 or 6 times greater than the amount of public financing, which is about what you'd expect. And the reason is that the public sector funding is not unlimited. It's based on tax dollars, and it needs to be used to sort of leverage private sector financing. So we've identified the sources of financing, we've identified these funds. What's going on here at this workshop is actually making those direct personal connections, which can also help overcome the gap. Again, the gap being, there's several different gaps. The gap between the policy discussion and the finance discussion, the gap between the projects that they want funded and the investors, which that gap exists because of lack of being able to identify and cultivate bankable projects and bring them to the investors.